Welcome back to the Deep Dive. We are jumping straight in today, really getting into the thick of it with CoreWeave's Q3 2025 results. These dropped after hours on Monday, and, well, if you're tracking the AI cloud space, these were pretty seismic.
Yeah, absolutely. They show both the just explosive demand for AI, but also the real kind of ground-level challenges of actually building this stuff out at speed.
So our mission today, pretty straightforward. We need to break down the key numbers. Some are really staggering, and then figure out why the market, well, reacted the way it did.
Right, because there was immediate selling pressure, despite some great headline figures. So this deep dive is all about that disconnect, the gap between the fundamental strength and maybe some short-term worries.
Okay, let's start with that top-line snapshot. The numbers themselves, they paint quite a picture.
They really do. CoreWeave just hammered expectations.
Revenue hit $1.365 billion for the quarter. I mean, put that in context. That's at 134% year over year, way above consensus.
And profitable growth, too. Adjusted EBITDA came in at $838 million. That gives them a 61% adjusted EBITDA margin.
61%. That's huge for infrastructure.
Massive. It tells you they're not just winning deals, they're pricing them well. And even the GAAP EPS loss, 22.2s, that was actually a significant beat, too. Consensus was expecting something closer to a 55-cent loss, maybe more.
Okay, so financially, Q3 looks like a runaway success story. But the shares fell 6 to 7% after hours.
Exactly. Even though traders were apparently pricing in a pretty volatile move, maybe 12, 14%.
So you just can't ignore that reaction.
Yeah.
Why the cold shoulder from Wall Street after such a strong quarter?
Well, I think the market wasn't really trading the Q3 success. It was looking ahead, trading the Q4 and maybe Q1 outlook, where a potential risk emerged.
Okay.
But before we get to that friction point, that bottleneck, you have to grasp the sheer scale of the demand they're actually locking in. And that brings us to the first deep dive, the backlog.
Right, the RPO, remaining performance obligation. Let's nail this down because it's probably the single most important number in the whole report. For anyone maybe not living and breathing cloud accounting, what does RPO really tell us here?
It's absolutely critical. RPO isn't just wishful thinking or potential demand. It's guaranteed future revenue locked in by contracts.
Okay, and the number?
CoreWeave's RPO ended the quarter at a staggering $55.6 billion.
$55.6 billion.
Billion, yeah. It nearly doubled just from the previous quarter. And year over year, it's up 271%. Management made a point of saying they hit $50 billion in RPO faster than any cloud provider in history. That's the proof, right? The load-bearing proof of this AI demand wave.
Wow. That level of guaranteed visibility, it's almost unheard of. And we know what's driving it, right? Those huge deals.
The expanded OpenAI commitment, that's now up to around $22.4 billion total. And the Meta agreement confirming up to about $14.2 billion over several years.
And with that kind of visibility, they've also been able to tackle customer concentration risk. That was a worry before.
Exactly. That's a key positive here. If you remember, start of the year, one big customer was something like 85% of their backlog.
Right.
Now, no single customer is more than 35% of that $55.6 billion. That is a huge structural improvement. Plus, they mentioned over 60% of that backlog is tied to investment-grade customers. So, reliable payers.
Okay, but I want to pause on the financials again. You mentioned the 61% adjusted EBITDA margin, which is fantastic. But they still posted a GAAP net loss of $110 million. How does that work? Billions in revenue, great margins, $55 billion guaranteed future work. Still losing money on the GAAP basis.
Yeah, it's the reality of hyperscaling infrastructure. It really comes down to two main things. First, just massive depreciation and amortization. They're building incredibly fast and writing down those assets.
Okay, makes sense.
Second, the cost of financing that build-out, it's enormous. Interest expense in Q3 alone was $311 million.
Wow.
And they guided for the full year FY25 to be somewhere between $1.21 billion and $1.25 billion just in interest expense. That shows you the sheer cost of the debt needed to fuel this explosion in capacity.
Okay, that makes sense. And it leads us perfectly into the reason the stock dipped, despite everything else looking so strong. Deep dive number 2, the bottleneck. With $55.6 billion on the books, why the market jitters.
The jitters, the panic, it really stems from the trimmed guidance. Management pulled back slightly on the full year 2025 revenue outlook, now $5.05 to $5.15 billion. And they also trimmed the CapEx guidance down a bit to $12 to $14 billion.
And the reason they gave It wasn't the usual suspects, was it? Not Nvidia missing GPU shipments, not
Yes.
trouble getting power.
No, exactly. It was very specific. It was attributed to a temporary delay from one single third-party data center
Developer.
and they were crystal clear about what the bottleneck has become. It's the delivery of the powered shell.
The powered shell. Okay, explain that for us. We're talking about the actual physical building, right? Not the tech inside.
Exactly that. The powered shell is the facility itself. The concrete, the roof, the heavy-duty cooling, the high-voltage gear inside the building that distributes the utility power. It's the bricks and mortar, basically, that you need before you can even start racking the servers and GPUs.
Huh. So the bottleneck isn't silicon anymore or even getting power to the site. It's getting the building ready.
It seems that way, at least in this instance. The shortage or the delay has shifted from, advanced tech to fundamentally a construction and real estate development challenge.
Okay, but hang on. If the customer is still committed and management specifically said the affected customer agreed to just extend the contract term, keeping the full value, why the panic?
Yeah.
It sounds like just a Q4 delay pushing revenue into Q1 2026.
Well, that panic, I think, it's rooted in execution predictability for growth investors. Any slip in that build-out cadence, even if temporary, it raises a red flag. But management framed it, I thought, quite well. They stressed this is a timing issue. It means revenue deferral, not lost demand. The $55.6 billion backlog, still intact. They see this powered shell issue as more of a systemic friction point across the whole industry right now, especially as builds get bigger and faster.
So how are they trying to mitigate this new physical bottleneck risk?
Two main approaches. First, diversification. They made sure no single data center provider handles more than 20% of their contracted power going forward, spreading the risk.
Okay.
Second, and this is maybe the more interesting long-term move, they're leaning much more heavily into self-build projects. They mentioned expansions in Lancaster, Pennsylvania, and the UK specifically, taking control of the construction themselves.
Gives them more control over the timeline, presumably.
Exactly. Control over the very structures that are now causing the delays.
And the timing outlook for this specific delay, what do they say?
They expect the vast majority of the CapEx that got pushed out of Q4 2025 to land squarely in Q1 2026. So if they execute, it should be a relatively short-term blip.
Okay, so shifting gears a bit, let's talk about the competitive moat. To justify the valuation needed to support that huge backlog, they need to be more than just, a big buyer and reseller of Nvidia chips. They need to differentiate from AWS, Azure, the big guys.
Absolutely. And they hammered that point home on the call. They highlighted their tech edge. They were first to deploy the new Nvidia GB300 NVL72 systems. That's a big deal. Requires serious engineering.
Right, that's cutting edge stuff.
And they got external validation too. They received the Platinum Cluster Max ranking from Semi-Analysis again, beating major hyperscalers. It sort of backs up their claims of infrastructure innovation.
And beyond the hardware, the software layer.
That's the other key differentiator they're building. They launched CoreWeave AI object storage. And what's really interesting there is the pitch. Cut customer storage costs by over 75%. And this is huge. Eliminate egress fees.
No egress fees. Okay, explain why that's such a big deal in the cloud world, especially for AI.
Egress fees are what you pay to take your data out of a cloud provider's system. AI models are incredibly data intensive. Moving large data sets around can get really expensive really fast. So removing that fee, that's a major draw, a big stickiness factor. It makes it much easier for customers to use CoreWeave without feeling locked in by cost.
Got it. That makes sense. And they're also expanding their reach through acquisitions.
Yeah, targeted ones, things like OpenPipe, which helps with serverless reinforcement learning tuning, and another called Monolith, which seems to be pushing them into industrial enterprise use cases. They mentioned partnerships with auto OEMs like Nissan and Stellantis, so moving beyond just AI startups.
Interesting. Let's circle back to that Nvidia deal, the $6.3 billion strategic collaboration. You mentioned the capacity is structured differently.
Yes, it's quite clever. The capacity built under that specific deal is interruptible. It's designed primarily to be resold to smaller AI labs, startups, the long tail of the market.
Okay, so interruptible means Nvidia could potentially reclaim it if needed.
Potentially, yes, but the structure allows CoreWeave to serve these smaller, high-growth customers, while Nvidia effectively underwrites the utilization risk for that chunk of capacity. It's a smart way to address a different market segment with less risk. And importantly, because of accounting rules around interruptible capacity, a lot of this isn't even included in that main $55.6 billion RPO number.
So the total contracted commitment is actually even higher than reported RPO.
That's the implication, yeah. The visibility is potentially even stronger.
And looking further out, their confidence seems, well, pretty high. Total contracted power is now 2.9 gigawatts.
Right. And they still have over 1 gigawatt of that available to sell within the next year or two. And the kicker, their forward CapEx guidance for 2026. They expect it to be well in excess of double the 2025 number.
Double. That's not the language of a company worried about demand slowing down.
Not at all. It screams long-term confidence. And crucially, they seem to have the financial muscle to back it up. They secured $14 billion in debt and equity funding just this year so far. And they're actively bringing their cost of capital down. They mentioned their DDTL 3.0 facility priced at SOFR plus 400 basis points. Now, that might sound technical.
Yeah, break that down. Why does that matter?
It matters because it means the interest rate on the money they borrowed to build these incredibly expensive data centers is getting significantly cheaper and more secure. That's a huge long-term advantage compared to rivals who might be relying on more expensive or less stable funding.
Okay, that structural advantage, the cheaper borrowing, the massive backlog.
Yeah.
It leads us right into our final segment. This is not financial advice. Time for the outrageous but plausible trade idea based on this whole picture.
Exactly. And the whole premise here is pretty simple.
Yeah.
The market seems to be overreacting to a short-term temporary timing risk.
While the fundamentals, driven by that $55.6 billion backlog, point to massive, unprecedented long-term certainty.
Right. So the opportunity is in that gap. Betting that the market's got the next 3 months may be wrong, but the next 18 months fundamentally right.
So what's the trade? How do you play that gap?
Okay, again, not financial advice, just an idea. You leverage the market's immediate fear about this Q4, Q1 execution slip. The idea is an option strategy. You sell volatility related to this immediate delivery issue.
Meaning sell puts.
Specifically, selling short-dated, maybe slightly out-of-the-money puts. The market's pricing fear into those options right now because of the guidance trim. By selling them, you collect premium. You're basically getting paid to take on the risk that the market is overstating.
Okay, so you collect cash by selling those puts. Then what?
Then you take that premium, the cash you just generated from selling the market's fear, and you use it to finance a long position, specifically buying deep out-of-the-money calls, maybe going out into 2026.
So using the short-term fear premium to buy long-term upside potential cheaply.
Precisely. It's a leveraged bet. You're betting that by, say, Q2 2026, this powered shell delay is sorted out, the execution cadence is back on track, and that massive $55.6 billion backlog really starts converting into recognized revenue at full speed.
And that conversion, that should be the catalyst to drive the stock price much higher, maybe closer to where its peers have been trading based on their growth.
That's the thesis. It's essentially a bet on execution normalization, using the current panic about timing to buy exposure to that massive future growth potential for less. The risk, obviously, is that the delays do drag on past Q1.
Right. The puts you sold could end up in the money?
Correct. But the reward, if the thesis plays out, is capturing significant upside leverage as that huge backlog finally gets unlocked and hits the income statement.
Okay, so wrapping this up, the core tension from CoreWeave's quarter is crystal clear. Record-breaking demand, this incredible multi-year backlog validating the whole AI infrastructure boom.
Versus the very real near-term friction points of actually building the physical infrastructure required at this unprecedented global scale and speed.
It feels like the company successfully won the race for demand. They proved that with the backlog. Now the challenge shifts, right? It's about building a robust, predictable execution platform.
Exactly. Their next chapter, their success from here, it really hinges entirely on normalizing that build cadence, smoothing out these bumps, and efficiently turning that $55.6 billion backlog into actual revenue without more significant delays.
Which leaves us with a final, maybe provocative thought for you, the listener, to consider.
Go on.
If this supply chain friction really has shifted, maybe more permanently, away from scarce things like GPUs and power, and towards basic physical infrastructure, these powered shells, does CoreWeave's big strategic pivot towards self-build change the game?
You mean, does controlling the construction itself give a specialized player like them a structural, maybe lasting advantage over the giant hyperscalers, who mostly rely on third-party developers for their buildings?
Yeah. Could that be a new kind of moat in this AI infrastructure race? Something to think about. We'll leave you with that.